Here is a 3-year Tesla owner sitting in a dealership service waiting room, staring at a repair estimate for a door actuator fault that his car flagged on a Tuesday morning. The appointment took 11 days to get. The loaner vehicle was unavailable. He took rideshare to work for a week and a half at roughly $28 a day, which means he spent nearly $200 getting to a job he drives to in a car he owns. The repair itself, $640. Total damage from one door sensor, over $800 and 11 days of disruption on a vehicle he paid $43,000 for less than 3 years ago. He is not an outlier. Owner forums and consumer complaint filings show this pattern repeating across tens of thousands of vehicles. And the car quietly sitting in the next lane at the traffic light, the one that cost half as much and came with no subscription fees and no 11-day wait, is not from a brand anyone in this country was supposed to take seriously. Tesla made the electric vehicle a product that adults actually wanted to own. That sentence needs to sit for a moment, because it is easy to take for granted now, and it absolutely should not be. Before Tesla built a car with real range, real performance, and a charging network that worked, the electric vehicle market was a collection of short-range compliance cars that automakers built because regulators told them to, not because buyers asked for them. Tesla changed that permanently. The Model 3 became the best-selling electric vehicle globally across multiple consecutive years, according to industry sales tracking, and it earned that position by being genuinely better than the competition at the time it launched. The supercharger network, which the company spent over a decade building to more than 50,000 stalls worldwide, according to company-disclosed figures, is the only charging infrastructure in North America that most long-distance EV travelers would describe as reliably functional. That is not marketing language. That is a decade of capital investment that no competitor has matched. The Autopilot hardware stack is a real engineering achievement. The software integration, the energy management, the mobile app ecosystem, the over-the-air updates that improve the car after you buy it, all of it represents genuine innovation that competitors are still trying to replicate. Tesla makes an outstanding car. Nobody serious is arguing otherwise. But a great car means nothing if the ownership math stops working before the loan does. And for a growing segment of buyers, the math has stopped working. Not for early adopters who bought a Tesla because it represented something. For the second-wave buyers, the practical ones, the commuters and second-car households and urban drivers who looked at the total cost of owning a $40,000 electric vehicle over 5 years and found a number that a $21,000 alternative makes increasingly difficult to justify. That alternative comes from Chinese manufacturers who have spent the last decade building affordable electric vehicles for the world's largest EV market and are now selling them in Australia, across Europe, and into markets where Tesla set the benchmark and left a price gap large enough to drive through. The question is not whether the Chinese car is as good as the Tesla. The question is whether it is good enough for the actual use case of the actual buyer. And on that question, the answer for a significant portion of the market is yes. The first advantage shows up at the dealership, before you ever turn the key. A Tesla Model 3, at its current entry price of roughly $40,000, financed over 60 months at prevailing auto loan rates, generates somewhere between $6,000 and $8,000 in interest over the life of the loan according to standard amortization estimates, though exact figures depend on the buyer's credit profile and market conditions. A $21,000 Chinese EV, the BYD Dolphin sitting around that price point in Australian and European markets, according to published pricing data, financed on identical terms, generates $3,000 to $4,000 in interest. The principal difference alone, roughly $19,000, does not disappear. It sits in the buyer's bank account. It covers a year of mortgage payments. It buys 5 years of electricity for the commute itself. Run the arithmetic on a household driving 12,000 miles per year, and the purchase price gap translates to roughly 37 cents per mile of premium the Tesla buyer is paying above the functional alternative, before a single maintenance dollar is spent. That is the floor of the cost difference. It only grows from there. The market signal validating this shift is visible in Tesla's own used vehicle pricing. After Tesla cut new vehicle prices by as much as 25% across multiple trims in 2023, according to widely reported automotive press coverage, used Model 3 values dropped sharply on platforms that track listing prices and days to sell. Owners who purchased at 2021 and 2022 premiums absorbed depreciation losses that had nothing to do with how they treated the vehicle and everything to do with a corporate pricing decision made in a boardroom. The second advantage shows up 12 months after purchase, when the software invoice arrives. Tesla's full self-driving package, which the company has priced at various points as a purchased add-on or as a monthly subscription, has been estimated at around $99 to $199 per month for the subscription tier, according to pricing reported in Automotive and Technology Press. Features including enhanced autopilot capability and certain driver assistance tiers sit behind additional paywalls on hardware that is already physically installed in the vehicle at the factory. Industry analysts have estimated the FSD attach rate among Tesla buyers at below 50%, meaning the majority of owners are already declining the product's headline software feature. They are paying the brand premium without accessing the brand's primary differentiator. Budget Chinese EVs in this price band do not offer a comparable self-driving system. That gap is real and will be acknowledged shortly. But the features they do include heated seats, navigation, app connectivity, basic driver assistance systems, arrive activated at purchase with no recurring fee attached, according to the feature specifications published by manufacturers like BYD. A Tesla owner who subscribes to FSD at $199 per month over 36 months spends $7,164 on software for a vehicle they already own outright. A commuter who needs lane keep assist and adaptive cruise control and nothing more is paying a technology tax on a capability they will never use. Over 5 years, the software cost differential between a fully subscribed Tesla and a base spec Chinese EV adds conservatively $5,000 to the Tesla's true ownership cost. The third advantage shows up the first time something breaks. Tesla operates a direct sale, direct service model with no independent dealer network. Service centers are company-owned, concentrated in population centers, and serving customer bases that have grown faster than the service infrastructure around them. Owner-reported wait times for non-urgent repairs have reached 1 to 3 weeks in lower-density markets, according to consumer complaint records and automotive owner forms, though Tesla's mobile service program handles minor issues without a center visit. Structural faults, suspension concerns, and complex electronics require the service center itself. When the appointment is 11 days out and the loaner pool is exhausted, the cost does not disappear. It transfers to the owner in the form of rideshare bills and lost productivity. A Tesla owner absorbing 10 days per year of service-related vehicle unavailability, paying $25 per day in alternative transportation in a mid-sized city, adds $250 annually to true ownership cost. Over 5 years, that is $1,250 in hidden service downtime expense, the ownership calculator never printed on the window sticker. Chinese EVs sold through established franchise dealer networks, as BYD and MG have structured their distribution in Australian and European markets according to industry reporting, introduce competition into the service equation. Multiple service points, competitive labor rates, and the ability to escalate through a franchisee structure represent a real structural difference in the ownership experience. J.D. Power's quality and satisfaction data on Tesla has shown variability in recent years as the ownership base expanded beyond early adopters into buyers with standard service expectations, though Tesla has historically declined to participate in some J.D. Power survey programs according to methodology disclosures. The fourth advantage shows up when you try to sell the car. A Tesla owner who purchased a Model 3 in 2021 or 2022 during the period when chip shortages drove new vehicle premiums well above MSRP, and who is now trying to trade in or sell privately, is looking at depreciation figures that would be difficult to explain to a buyer who was not there for the price cut news cycle. Industry depreciation tracking data, reported by automotive research platforms, suggests that the 23 Tesla price reductions created a simultaneous markdown of every used Tesla on the market, not because the cars aged, but because the manufacturer repriced the new version below what the used version could command. A buyer who paid $47,000 for a Model 3 in 2022 and found it worth $30,000 18 months later absorbed a $17,000 depreciation event while making every monthly payment on time. A vehicle priced at $21,000 new carries a structurally lower depreciation floor. The dollar value loss on a car that starts at $21,000 is bounded by the entry price in a way that a $45,000 car simply is not. Exact resale data for Chinese EVs in Western markets remains limited given how recently brands like BYD have entered those markets, and any projection should be treated as directional rather than definitive. But BYD sold more than 1.5 million battery electric vehicles globally in 2023, according to company sales filings, a volume that creates the secondary market infrastructure, the parts availability, the independent mechanic familiarity that makes resale viable over time. Tesla genuinely still wins in specific situations, and those situations matter. The supercharger network is a real competitive moat for any buyer who travels distances that require fast charging. No $20,000 Chinese EV offers comparable long-haul charging infrastructure in North America, and that gap is not narrow. Tesla's thermal management system carries years of proven real-world data in cold weather climates, where budget Chinese EVs have limited Western track records. The brand still carries financing and insurance advantages in markets where lenders and insurers are more comfortable with established names. These are honest concessions, not rhetorical throat clearing. But consider what Tesla's own behavior signals about the competitive pressure it is under. The company that spent a decade holding premium pricing cut new vehicle prices by up to 25% in a single year. That is not the pricing behavior of an unchallenged market leader. That is a response. Tesla's gross margins, publicly reported in quarterly earnings filings, declined through that same period as the cuts took effect. And when asked publicly about the competitive threat from Chinese manufacturers, Tesla's own chief executive described BYD as a very strong competitor, according to widely reported remarks, which is a notable admission from a company that spent years treating the EV market as its own category. The regulatory picture adds another layer. The European Union announced provisional tariffs on Chinese EVs in 2024, according to widely reported policy coverage, an acknowledgement that Chinese manufacturers had become competitive enough to require trade protection. But tariffs raise prices without eliminating the value proposition, and they do not apply in Australia, Southeast Asia, or South America, as of this writing. The pattern playing out in electric vehicles mirrors what has already happened across other industries, where a Western incumbent with superior brand equity and established infrastructure lost ground not to a technically superior challenger, but to a challenger that won on the economics of ownership for the buyer who shifted from aspirational to rational. The question widening past this single model comparison is whether the Western automotive industry will produce a $20,000 electric vehicle before the Chinese industry locks in the buyers who have already decided it does not need to. Tesla is not going anywhere. The supercharger network alone is a competitive asset that took a decade and billions of dollars to build, and it does not dissolve because a cheaper car appears in the next lane. The brand still means something real to a generation of buyers who associate it with the moment electric vehicles stopped being a sacrifice and became something people actually chose. That is not a small thing, but the buyers switching are not those buyers. They are the ones who came later, the practical ones, who bought a Tesla because it seemed like the rational choice and discovered the ownership math had quietly shifted on them. A subscription fee for heated seats on hardware they already paid for. An 11-day wait for a service appointment on a car with a 5-figure loan balance. A depreciation event that arrived not from age or neglect, but from a boardroom pricing decision. When the rational buyer leaves, the brand does not replace them with a new wave of rational buyers. It contracts toward a smaller, more loyal, more premium audience, and it cedes the volume market to whoever showed up with a lower number on the window sticker. A car company that charges you monthly for features installed in a vehicle you already own is not selling you a car. It is renting you access to what you thought you purchased, and someone just opened the lot next door, priced $20,000 cheaper with no monthly invoice attached. If you want to see more, click the video on screen now.